if you put this one here, so we are supposed to fake drinking coffee.
Yes,
Can we put this inside your shirt?
Yeah, of course.
and I'll give you some water.
What people, yeah.
Yes.
And then we see how much
Yeah,
we go
yeah.
into wealth inequality.
Okay, good. Hi, and welcome to Central Questions. My name is Stefan Ingves. I'm the former governor of the Swedish Central Bank, and I'm hosting this podcast series. Today we're going to talk about household investments, savings, and what households actually do. And it strikes me when I started sort of thinking about these issues that back in the 90s we had a serious financial crisis in this country, and I was Director General of the Bank Restructuring Agency, and it was my job to do my best to clean up the mess we had ended up in. And what struck me many years after is that various individuals came up to me and said, I lost a lot of money in the early 90s, and I had serious difficulties paying my mortgage. So whatever you do, Stefan, in the future, make sure that this never ever happens again, because I really got hurt. And I don't want others to go through that pain. So that's part of my experience when it comes to this. Today, when we're going to talk about financial decisions in the household sector, I'm happy to have with us Professor Paolo Sodini from the Stockholm School of Economics and the Swedish House of Finance. And Paolo has a ton of experience when it comes to trying to figure out what households do or do not do when it comes to financial decisions. But before we get into that conversation, so could you please just with a few words say a few words about yourself and also the academic work that you have done in this field and other fields.
Yes, thank you, Stefan. I'm super happy to be here. So yeah, I was fortunate enough in my career to stumble in exceptionally good data on what households do in financial markets, how they use financial instruments, how do they save, in which type of instruments they save over the life cycle and so forth. The data, the exceptional data, is actually Swedish data. There used to be extremely high quality all the way to 2007. And then kind of continues, but somewhat at the same level. But those years were really gold in order to understand what households do. And so I was able, it was a little bit like putting the Hubble telescope in orbit, if you want. So suddenly we could see things that we couldn't see before. You could see stars that or behaviors that we had no clue about. And it was for the whole population, and it was very detailed at the level of single instruments, actually, financial assets. And so we could ask questions that were not, that was not possible to ask before. And these questions were precisely, and this kind of led me, throughout my career, trying to understand how households use financial markets. And in fact, from the initial work and my collaboration with John Campbell and Laurent Calvet, it came up also the term of this new field in financial economics, which is called household finance, which John actually used or introduced as a new terminology, as a new field in his presidential address, which was largely based on the first paper written on the Swedish data.
Yeah, but then when it comes to household finance and household behavior, one of the issues which I already alluded to is that sometimes you are successful, sometimes you are not, and then it can be quite painful, and sometimes only individual households run into trouble, but also in less fortunate episodes, thousands and thousands of households run into trouble. And sometimes I get the impression that you have elements of what I would call herd behavior, because everybody is running in the same direction, and then things blow up. What have you learned when it comes to mistakes?
I think, first of all, you're referring to two different types of risk. One is kind of systematic risk. So, however I invest my money, to a certain extent, I'm going to be exposed to kind of overall market fluctuation. That's a systematic type of risk. And when things go bad for the whole economy, many people get hurt. So there isn't much you can do to avoid that type of risk, apart from the fact of making sure you don't take too much of it. Okay, so you have built a buffer that kind of allows you to go through those times. And it's something probably we'll get back to when I think about systematic risk in your financial portfolio. I think it's extremely important to consider and to have an holistic, or let's put it this way, when you consider risk in your overall balance sheet, it's important to have an holistic perspective. Your balance sheet also has your own human capital. All the income you're going to receive throughout your life, the present value of it. And that also is heavily susceptible to fluctuations of financial markets and the overall economy. So it's important to take systematic risk in a very intelligent and smart way, to consider also the risk coming from your career, your own income. The other part is some people might actually take on too much, let's call it specific, or we use the terminology idiosyncratic risk. That's unnecessary. Going back to Sharpe and the CAPM, that's a risk that typically is not compensated, and you should minimize that heavily. That's something people don't really fully understand. And how do you minimize it? Well, you diversify your portfolio. Not many people do, and many products are out there that actually are not fully diversified. That people have a hard time, kind of following, making sure that they minimize idiosyncratic risk in their whole balance sheet. And bear in mind, the big part of idiosyncratic risk comes from your own career. You have one career. You work in a certain sector. You have one type of education. You have one company, if you are an entrepreneur, which is in a certain sector, which is specialized in a certain product or services and so forth. That's enormous idiosyncratic. Oh, you have a house that lives in a certain location. That's idiosyncratic risk. So you already kind of have a lot of it, and the only place where you can actually do a lot to minimize it is your financial investments. Right?
But then on that note, because you're sort of saying that life is a risky business.
Yeah, totally.
And you cannot really change that. Then, given your knowledge and all the massive data that you have churned over the years, what would your advice, maybe it's to say too much, but how would you explain to a household then how to think about these things in order not to run into deep trouble?
Yeah.
Because we know that's sometimes it's even for a generation painful to dig yourself out of a hole you ended up in.
Yeah. So there are, I would say, let's say three things. The first one is to decide part of the decision how much to save and how much to consume should be driven by the fact that you have built a buffer to go through those tough periods. Okay, and this buffer should this buffer should not just be invested in instruments that actually are not that exposed to overall kind of aggregate fluctuations. Okay, so when things are very bad, those money actually do not lose value, and you keep them in your bank account, or even better if you keep them in bonds, government bonds specifically. That's the first part. The second part, the second part is how much risk you take, how much you keep in safe asset, how much of the buffer you have built, how much you keep in safe asset bonds, how much you invest in risky assets. Okay. That's a decision that is driven by your own risky attitudes. Okay, so everyone has different, kind of willingness to take risk. That should be taken into account. But a huge component that should be taken into account in that decision is the type of risk you have in your human capital. Okay, and when it comes to most of us, meaning all of us that actually get most of their resources throughout their life through labor income. Okay, when it comes to instead probably richer households, most likely the reason why they become very rich is that they had a successful business. That's another dimension of a lot of risk you have to live with, as you say. So what you can do is that when you decide how much risk you take in your financial portfolio, where really you can decide, whereas these two other parts you cannot do much about, at least in the short period, then these two elements, human capital and your own entrepreneurial business, your own company and so forth, should be heavily taken into account because they are a huge part of the future stream of cash flow out of which you're going to consume, okay? And so if you work in sectors or you have businesses that are very, very risky, you should limit how much risk you take in your financial portfolio.
But let me sort of a follow-up to that, because in the case of Sweden, we have discussed the housing market since forever. Yes. And we do know that most households today have variable rate mortgages.
Yes, that's another.
And if you have a variable rate mortgage, we do know that from time to time interest rates go up a lot. And do you think that everybody's aware of that? Because very often for the past 30 years or something like that, the advice has been to have a variable rate mortgage because the real rate was actually dropping for a long time.
Yes.
But today, because rates are going to go up sooner or later.
It's very difficult for me to say to the extent to which people are aware of it. You need to have surveys, which we don't have, to answer the information. And you need to have very good data of how people's finances look like, which we don't have as good as we used to nowadays, okay, in current times. However, I think that, so the decision whether to fix or not interest rate heavily depends on how much riskiness you have on your income, okay? So if you are in a sector, you have a business that is exposed to large fluctuations, you might become unemployed, your bonus could be very, very low or non-existent in certain times, or your business might get in trouble. When you are in those situations, very likely, for people who are likely to experience those type of events, they should try to fix interest rate. So when things get really bad, at least the interest rate, is not going to fluctuate that much. But if you have this buffer, if you have enough equity on your house, if you have ways to actually chip in when interest rates go up, then it's much cheaper to have variable rates than fixed rates, because you don't pay the premium for the fixing, basically. But it's a hugely important component, and in fact, when I was talking before, another variable you should consider is how much real estate you have, and how variable is the level of this real estate, and especially how do you acquire that real estate? Are you levered through the roof, or are you not? How much equity do you have in your house? So one way to build this buffer, in fact, is to build enough equity. So when things are really bad, you could actually borrow against it. It's something we see in actually one paper that I have with some of my co-authors in the AR. We actually study the behavior of people who have randomly, and we can talk about it, been given a large buffer in their housing equity versus people that are not. And in fact, when things are very bad, we see those that, for people that actually have large shocks to their income, we see that actually by accessing this equity, they are able to smooth consumption. So we see their consumption to remain more or less stable, whereas the renters, those that don't have built enough equity or they don't have it at all, we see consumption going down with income. There is nothing they can do.
But you have all the concepts and you have studied this for years, and that means that you can sort of make these comparisons probably in a more rational way than many others, because you are the specialist. But that brings us into the whole issue of what I would call financial literacy.
Yes.
Because these are kind of complex matters, and most households, most individuals are not economists, and they do all sorts of other things, and you can be a super expert on some tiny aspect of life in our societies, but still you are expected to reflect on how to use your money, and what to do and what not to do. So do you have strong views on financial literacy and what to do there?
Yes, so there are, so let's unpack this a little bit. So we know we have recognized for a long time in financial economics that people are not perfectly rational, okay? And the reason why we build models with perfectly rational people in them is I would say to actually provide people with normative advice, with norms that they should follow. So if we have models that tell us what the perfectly rational agent should do, and so we can tell people this is what you should do. This brings me to the notion of scientific financial advice. I think we know so much in financial economics that we can start thinking about, what is a scientifically based financial advice. And unfortunately, the problem is that the scientifically based financial advice is not really what is followed out there. I think as a mix of people not being aware of it. In fact, I teach it here, and my students are largely surprised of some concept that I bring to class. And also the fact that there might be conflict of interest between the advisors and the client. Okay, so we know people don't. The question is like how far people are from this kind of perfectly rational, agents that we have in our model. So we try to model them with, financial, with behavioral finance type of concepts. But the question is like in which areas mistakes. So first of all, are deviations from optimal behavior mistakes, or are they behavioral biases that whatever you do, people can't avoid kind of not behaving rationally? All right. The first thing to say is that we have a lot of evidence that a lot of deviations from this optimal behavior are indeed mistakes. And in fact, when you look at people that have higher level of education or have, they are more sophisticated by other measures such as how wealthy they are or their IQ and things like that, we see that they behave closer to the rational benchmark, okay? This gives us hope. It means that if you can teach people to behave, optimally, all right? The question now, is it easy to teach people to behave rationally? Is it easy to improve financial literacy in the population? That's actually very difficult. There is a lot of evidence that actually this type of, whatever we teach in terms of optimal behavior tends to be short-lived. People go back to their own kind of mistakes, if you want.
Can you give me an example of non-rational behavior?
Yes, so, for example, diversification, okay? So you should be diversified in your portfolio, not only across all financial assets, but also considering that you have so much human capital in your business. So if you are heavily, if you're working in manufacturing, when you invest your own money, don't try to invest in stocks that actually move a lot with the manufacturing sectors, because when you lose your job, also your savings are going to lose in value. Something that people tend not to understand. They think they try to invest in what they find familiar, so they actually feel more comfortable investing exactly in the same sector where they work, which is very bad, because both your savings and your income is going to go down. So diversification forget about the holistic thing, even income. Even if we just look at the financial portfolio, people tend to diversify. To tend to have not fully diversified portfolio. I think it's a huge mistake. The second one is that you don't want to leave too much money on the table. Okay, you want to minimize how much you invest, how much you pay for the financial products that you have, and that's kind of a little bit counterintuitive. So this is kind of a general theme. I would say is that financial advice, what you should do is extremely counterintuitive, because like in other parts of our life, you know, you shouldn't follow what we actually do in other parts of our life. And this is one example. If you pay a lot for a mutual funds in terms of mutual fund fee, in any other part of our, or for a service, in any other part of our life, it's like if you pay a lot for a lawyer, probably the lawyer is better. If you pay a lot for the car, probably the car is better. If you go to a good restaurant, you pay a lot for a dinner, you know, probably the dinner is going to be very good. You actually feel it, whether it's good or not. Financial services and financial products are not experiential products. You cannot, by having taken a certain decision, financial decision, it's very likely that you will not experience the consequences of it for a long time or even ever, let alone the fact that it's extremely difficult to identify the counterfactual, okay? So if you buy expensive mutual funds, those fees are probably, you know, thrown into nothing, okay? We have a lot of evidence that it's so difficult to actually, you know, actively manage a fund and beat the market, that the fees that is charged is probably not worth it in most of the cases.
But that's hard. That must be hard to do, because if you use the example of mutual funds, and there must be thousands of mutual funds out there. So
yeah, exactly.
So what you can choose from is basically beyond most individuals' comprehension.
Absolutely.
And still you have all these people telling you that my mutual fund is the most wonderful
Yes.
thing in the world,
Yes.
and you should buy my stuff.
Yes.
But that really requires, or almost demands, financial literacy.
Absolutely, absolutely. That's what I'm saying. So I think that we really need to get financial literacy very early on. It should be like, you know, so ingrained with you in your education that it's like 1 + 1 = 2. Okay, that's the level. So I think if we arrive at that level, then people will be able to take financial decisions and choose financial products much better. And I completely agree. It's extremely counterintuitive. And the good news is that at least now, the products you should buy are available. Around this 1,000, I can give you 10 or 20 that where you should actually put your money. And the problem is also that people there is this misconception of what financial markets are and how, you know, and what does it mean to be successful in financial markets. People think, often you know, I'm out for dinner with my friends, you know, and the topic comes up and people ask me, oh, okay, so you work in, your subject is wealth management and is you know, financial economics, how you invest your money. So you're going to be able to tell me how to become rich. And the answer is like, no, I'm not. You know, you can't expect more than, you know, 5-6% more than bonds when you invest in equities. Don't think that you're going to get 20-30% per year easily. I only have bad news for you, you know.
But let me add to that, because it strikes me when we're talking about financial literacy and sort of all the difficulties and all the nuances, that at the same time you need to somehow understand what I would call the preconditions, what kind of a financial sector you actually have around you. Mm-hmm. Because in the case of Sweden, we have been working at it, trying to create a very diverse financial sector for the past 40 years or something like that. And that means that the choices available to you are very different here, plus the fact that you can invest your money in New York or London or Singapore or whatever if you really want to. But if you talk to others in other parts of Europe, and many today on the political side are talking about the capital markets union or the savings and investment union. And then you look at other parts of Europe and then you sort of conclude that in most other countries within the EU, the system is very bank-centric. Mm-hmm. So there is nothing to invest in. Mm-hmm. And very expensive. Or very expensive. So what would your advice be given the differences when it comes to the financial sector?
So, I mean, obviously, you don't want to stop financial innovation. Okay, so I think that on the one side we have too many products, and on the other side we have too few products. Okay, so think about like very simple example. We don't have it in this country, but in many other countries such as Italy or the US, you have the possibility of refinancing your mortgage, right? So you fix your rate, and then if interest rates fall dramatically, you actually go back to the bank and say, I'm paying 5%, now the rates are 2%, can we renegotiate, okay? So this, one thing that strikes me is like, why don't we have automatically refinancing mortgages? It's extremely useful. Why do I have to go to the bank myself actively to do this refinance, to take this refinancing decision? Sell me a mortgage, then when the interest rate goes down, sufficiently, my rate is going to go down as well. And the answer is that, obviously, bank using the fact that some people actually do not refinance because they don't understand the rate went down, they don't understand the importance of it, they don't understand how much money they would save in that way. The banks are able to offer better rates to those that refinance, okay? And so you have this, this kind of market where the optimal option available out there is not taken on because you have uninformed consumers, okay? And that since it's so difficult to understand the value of financial services or financial products, that's the typical case we have in financial markets. Okay.
But that takes us sort of into the field you have spent a lot of time working on together with others, and that is sort of the question then in this environment, and the work that you and others have done is very much based on Swedish data, so that's kind of the starting point. Then whether households are well informed or not, what have you learned? What is it that households actually do? And are there huge differences then between households? Mostly we talk about and measure income because it's easy to measure income. It's a lot harder to actually measure wealth. Yeah. But we do have data, Swedish data, so you can sort of see if you have a lot of wealth, and so on.
Yes. So okay. So there is enormous heterogeneity out there. There are people, coming back to, there are people that are more rational and they kind of can exploit and use financial market efficiently. There are people that are more, either because they don't know or whatever, like they instead do not take optimal financial decisions. So there is enormous difference on that. The second thing is that there is enormous difference how much wealth people have. Okay, so there is very large wealth inequality. And there is very large wealth inequality in Sweden. So in Sweden, which is kind of surprising, it's a society where income inequality is not as high, is not very high by many standards, but wealth inequality is actually quite high compared to many other countries in the world, which makes it a very interesting case to study, by the way. But now what is interesting is that there is a strong correlation about on how much return you can obtain from your wealth and how wealthy you are. So what we see is that poorer people don't strive to achieve high returns on their wealth, and richer people instead have much higher returns, which means that basically they become wealthier and wealthier.
I was just going to ask, does that mean then that if you're poor, you will never catch up?
I mean, it means that okay, so there are two things here. It is true that being poor makes it more difficult to catch up because you don't take as much risk as richer people for many reasons, just because you just don't have the money at the end of the month to save and invest in the stock market, even if you do it rationally. But there is another mechanism that actually helps a little bit, is that a little bit paradoxically, I would say, partially paradoxically, partially not. The very, very rich people, you remember we were talking about systematic idiosyncratic risk? Yeah. They have a lot of idiosyncratic risk, which means that they might be struck by shocks that brings them down.
Okay, because they have everything in their own business, let's say.
So part of it is because they became rich through their own business. They still own it. They should own it because they were successful at it, and so kind of makes sense that their wealth is so concentrated in terms of risk. But we also have evidence, and there are some papers out there. So there is a paper by Bali, Gunadin, Karabulut, and Jansson, by the way, on Swedish data, where they look at very rich people, and even if they take away the money they have in their own company, the company that brought them to be rich, they still take a lot of idiosyncratic risk, okay? Which is kind of, they gamble. They keep gambling for some reason. This is good in a way, because this means that the people at the top are not going to stay there forever. There is a chance if their investment actually don't work out, that they actually might fall back in the distribution. For normal households, let me just add this, for kind of most of us, one important mechanism is actually, paradoxically, is a levered position in real estate. The fact that you borrow to invest in your house. That actually allows you to have very high returns, because you put in 10, you borrow 90, so the return turns out to be very high. And we see very strongly that this is a way for the middle class to actually, kind of climb the ladder of the wealth distribution. When we go outside, housing ownership, much lower in the wealth distribution, unfortunately, it's extremely difficult to get out of that. I think the only way is education. The only way is education and having a career that will give you enough income. The way to enlarge your cake, your overall wealth that you can generate to your life is education. So equal opportunity, the fact that everyone can access schooling very easily and cheaply, is extremely important.
But back to your reflection about risk or risk-taking or risk preferences, if I call it that, it has struck me, particularly with my background in crisis management, that some people are always willing to bet the farm, and others are extremely risk averse. And I have always sometimes wondered, why is it that if you're good for $1 billion, you make bets such that if I'm successful, I'm going to be worth $2 billion.
Yes.
But if I'm not successful, it's going to be 0.
That's a very good question. That's actually what this evidence. Initially I thought it was not the case. Okay. I thought that, okay, the main reason why when people become very rich, they actually don't diversify away and they just sit on this, 8% return per year and be happy forever and for their generation and their generation after that and so forth, was because they actually, it's their own companies, right? And they added so much value in that they want to divest. But as you say, indeed, this paper I was mentioning, they find out that there are, when it comes, not only when you become very rich, you tend to take a lot of risk, but you like to gamble. You like to, and I think it's because, I don't know, but I heard from some financial advisors, friends, and that, if you were able to be so successful with your own company, it's extremely difficult to think that you are not successful in choosing other company, other business, other ventures, or invest in new startups that are. It turns out after a few years, for people that have been doing that for a while, it turns out obviously that is extremely difficult, And so this brings us to the question: how much is luck that you arrive at the top, and how much is ability? I think definitely ability is there, but it's very idiosyncratic, very specific to that type of business. It's very difficult to take the lessons to other types of business. And I think when you it's also there is an important consideration here. It's like, lots of people at the top, they tend to take idiosyncratic risk not only by financing new small ventures, okay, new startups, but they actually pick stocks in the stock market, okay, and because they think, I think this is a good business, okay. People forget that there is the whole world And there is billions and billions and billions of dollars trying to figure out what is a good business versus a bad business. So the price you pay probably has already incorporated whatever information you think you might have because you have a lot of experience or you have been successful. So I would say outside private markets, okay, once we come to public markets, like listed companies, just diversify.
But that's kind of saying that if you find something that seems to be too good to be true, be careful.
Extremely, especially when there is a market for that price that is very liquid.
And in addition to what you just reflected on, you sort of hinted at the fact that if you take a lot of risk, sometimes you're successful and sometimes you are not. And that means that if you become really, really wealthy, it increases there will be an element of, I would call it churning. Because wealthy individuals or households some kind of come and go. But nonetheless, one conversation that we always have in most societies is the issue of wealth and wealth distribution, and how wealth distribution matters both from a sort of a value point of view, but also in politics. And that means that there is a sort of an inequality mechanism that is built into all these decisions. That matters, and it both matters, of course, to individuals, but it also matters at the macro level. And when you look at what has happened in this country, based on your studies, how would you approach that issue?
Okay, so okay, I would say you want to balance two things. You want to create enough incentives for people to start businesses and ventures that benefit everyone, in the sense that the overall cake for everyone is going to be larger. Okay, and obviously becoming rich is a very good mechanism. You know, so question is whether you need to be that rich to actually create this kind of innovation and creative destruction, if you want. So that's part of it, is incentive. You need to balance incentive. You can't have full equality. You know, doesn't matter what you do, you earn the same. Obviously, people, you know, will not try. Okay. Now, so that's one side of the coin. The other side of the coin, and in that sense, it's important that there is equal opportunities. Everyone can have access to this possibility of success. Now, when it comes to the level of inequality that we have right now, you can ask whether there is enough mobility, okay, given that there are these incentive mechanisms. That's actually something that I'm studying right now in a paper with Meran Ebrahimian, who's also here at the department. So we try to understand the extent to which children of rich people become rich during their life cycle. You know, how much this depends on simply the money they got from their parents, okay, and how much it depends on what they do with those money. And it's incredible that actually it looks like it's preliminary work, so we are refining it, but it looks like that a very large component is what you do with those money, not so much how much money you receive, okay? So here we go back to financial literacy, right? So it looks like children of rich people, they have a culture, they have knowledge, they have information that allows them to you know, to kind of accumulate wealth, no matter where they start, better than people that are children of less wealthy people. So
because they have been exposed to this conversation, is that your point?
I think we don't know.
Okay.
We just know that that's the case. Okay. We don't know exactly what are the channels. Okay. We are looking into it. Part of it is you know, you might be, but I'm just speculating. You might be less afraid to jump into the housing ladder early and taking more risk. Partially because also you have your shoulders covered by your parents, so that's you feel safer in a way. But partially could be just a cultural thing. I mean, of course I'm going to own an apartment in Stockholm, right? I mean, everyone does in my family. The second thing, you might be willing to be more entrepreneurial. Okay, so chances of success are going to be higher. So we don't know the mechanism. It's a super interesting question, but we definitely know that what you do with your money, it's extremely important, almost more important than how much money you expect to receive from your parents.
Let me give you a good example. When I arrived here at the Stockholm School of Economics, I had absolutely no idea how dysfunctional the Swedish housing market is. But those who grew up in Stockholm, they knew exactly what to do. That's one example
exactly.
of why this kind of matters. And it took me many years to sort of figure out what is actually going on here. But to those who actually grew up within the system, the insiders, it was sort of a given from the beginning what you should be doing.
It might be a super important factor.
So it matters. Well, the clock, time is running, and we have to sort of come to the end of our conversation. And there are many aspects of this, so we could continue talking about many more aspects of this. But it struck me that when I read your papers, all of it is, the database is fantastic, but only until 2007. And at the same time, this has been a politically highly charged issue in this country in order to ensure that in the future we are not in the know when it comes to people's wealth. As an academic, what's your reaction to that?
I have, I know this data, so thoroughly and so in depth. So there are two things. So first of all, there is no way we can improve the way our society, our economy works. And we know it needs to be improved unless we have information and knowledge, okay? And data is essential. Second consideration, it's a little bit absurd that private companies, I'm talking about big tech, know more than people that actually have to decide on laws and policies or even academics. Third, the guardrails to access the data are tremendous. Ethical committee reviews and so forth. So there are many ways you can keep collecting the data and make sure that it's not used badly. Fifth, I don't know which number I am actually, but it's actually a myth that by not collecting the data, it's less likely we're going to talk about put back, for example, a wealth tax. With the data we still have, I can easily point out, who's rich and who's not, to a very, very large extent. So actually, most of the data is still collected. All information on businesses, all information on real estate. You can easily find out how much debt people have because you know how much interest. There is so much information we collect anyway for tax purposes that I actually wonder, why did you have to take away this part that was so useful anyway? I mean, it's like if you want to put back the wealth tax, you could do it like that in a moment anyway. So that's actually, it's a big misconception. And other countries, such as Denmark, for example, they have abolished, now they're discussing putting back the wealth tax, but they abolished the wealth tax many, many years ago, and they kept collecting the data precisely for policy. So right now, we're basically, you talked about the fact maybe people are levered too much and they have variable interest rate, and and this might be a bomb that could explode at any moment. Well, we don't know. We don't know. We just don't have the data we used to have. Okay.
I do think we're in agreement here that we have some homework to do when it comes to this issue. Let me add one more question, and then I have a final question. you said that.
Just let me say one thing. When I said
Sure.
I could point out who's richer, obviously I don't know who is who.
Sure.
I never get data with any identity whatsoever.
I understand.
But someone would have this identity, which is indeed there in the files that are collected for tax reason, could do that. Okay, just to be clear.
You earlier said that when we discussed mutual funds and the enormous choice that's out there, and there are
Yes.
thousands of them,
Yes.
that there may be, and now we're going to talk about, we sort of have, what I have in mind is a kind of an average income household. There are about 20 mutual funds that it would make sense to invest
Yes.
in.
Yes.
But
Actually, I would say even two.
but who should tell all these households then about those two?
So I think that we need to think much more carefully about the financial advice sector, okay, or financial advice. Since the financial advisors are providing a product that is nearly impossible to understand for the average individual how good it is, because they can't experience how good it is. They don't know what's the alternative, and so on and so forth. We are talking about, you know, a situation like a market, if you want, that is closer to, health services, doctors. You go to a doctor, you just have to trust whatever he is or she is going to. If you take one pill or another, you never know whether it was the right decision or not. That's basically the same thing. So how do we solve it there? There are very, very strict rules and education and, kind of career path that you need to go through in order to become a doctor, right? We have none when it comes to financial, or very, very little when it comes to financial advice. So on the one side, I think we are a little bit, I'm not saying it's not important, but I think we are a little bit talking too much about financial literacy for the average household. We are not talking about financial literacy for the average advisor, okay? That's where, you might want to actually invest not so much on the financial literacy, not some of individuals, but make sure that financial advisors are extremely aware of what they should advise on, how they advise, and there should be more regulation on making sure that as it happens in the medical sector, like their incentives are exactly aligned with the ones of the clients. So we need to do a lot to regulate this market and make it really appropriate. And it's not that we don't have other examples. As I said, the medical sector is very similar in many, many aspects.
Then one final question. We have covered a lot of ground on a topic which is highly, highly relevant and very, very interesting. But something I have missed. Anything you would like to add?
Oh, no, so many, so many things. What can I say? Actually, it's very difficult to answer these questions. I would say, I think what you said actually, if something looks too good to be true, don't follow it, okay? So, when it comes to how you manage your finances, there are a few very well-established rules, and they're not difficult. There are good sources for it. In fact, if you just talk to ChatGPT and ask for some financial advice, what you will get is actually something pretty decent, I would say. So that's actually good. There is no easy way to make a lot of money in financial markets. Like, think more about your career, think more about your businesses. That's where you actually can make a huge difference, not by picking the best stock or investing in crypto, for God's sake. Yeah.
Sounds like very sound advice to me. So thank you for a very, very interesting and fascinating conversation. Thank you.
Thank you so much. Thank you.